Welcome to the EXP Express Notes for Foundations in Accountancy paper on management information. This paper is concerned with the nature of management accounting and information related to carrying out the management accounting discipline. When you have read the introductory pages to this set of notes, please move on to Chapter 1. Now, in this first chapter, we want to explore the what kind of information management needs in order to understand the costs and other relevant factors in managing a business. Let's begin at the most general level with regard to the business organization itself. If you think about it, you can imagine an organization as being a social arrangement which has collective goals. The important thing is that the organization is a group of people who come together to work in the direction of a common goal. In the case of business specifically, we are speaking of that goal being, generally speaking, the maximization of wealth of the shareholders. Remember, the shareholders are the owners of a business, and therefore the management and employees in a business are ultimately directed toward increasing the value of the shares of the business. They are working in behalf of and in the interests of the shareholders. Now, it follows that in order to be able to work towards a certain common goals, an organization has to be able to define and supervise and monitor its own performance against those goals. And therefore, we have to think about the organization as being a definition or an entity which can be distinguished from its environment. If you want to think about some other characteristics why people come together to form business organizations, you can imagine that one definite benefit is the shared expertise. Instead of a number of individuals sitting home alone separately trying to do business, by pooling their knowledge, the result becomes more powerful and more effective. So we can also say that in addition to sharing of knowledge and expertise, pooling of resources would be another a broader reason why business organizations, if they're well structured, can be quite effective. Now, just like in a school, for example, a business organization requires rules and procedures in order to perform properly. This is setting the norms by which the employees in a business are expected to behave and what is expected from them. These policies and procedures are normally contained in a manual, so they have a physical manifestation so that people can refer to them. In many companies, when employees begin work, they are often given a policy manual, or it may be called a staff handbook. That sounds a bit more friendly, so that they understand. They're given it the first day they start work by the HR, the Human Resources Department, and this is so that they have a way of becoming acquainted with the practices and the rules that govern the organization's operations. Now, why do we have policies and procedures? Is it because somebody's just interested in imposing total standardization across the organization? Well, having some sort of standardization makes sense. We don't want to suppress individual creativity or initiative, but there has to be some consistency across the organization with regard to the performance of work because if one person falls ill, for example, and someone else has to step into their place, they shouldn't be confronted with any surprises. In other words, in the daily operations of a company, there should be some degree of consistency and regularity to the way things are done, so that one person can substitute for another person and the organization doesn't stop operating properly. Also, in connection with business practices or business operations, risk is a major item that does concern management, and that is to avoid being exposed to unnecessary risks. So if you can imagine a construction company, its policies and procedures would certainly have a very important section on worker safety. The need to wear, for example, a safety helmet and gloves while on the work site, so that there is a reduced risk of injury to workers. Now, we're not saying that risk can be completely eliminated, but of course it's in everybody's interests, especially the workers themselves, and of course to the firm as well, that unnecessary risks be avoided. And in order to achieve this, a policies and procedures document would address or define what constitutes minimum acceptable behaviors and standards while performing the work. That's avoiding risk. If we want to look at this more positively, we could also say that there may be a inclination or an interest in setting standards according to what is the best way in which a job can be performed. In other words, a business organization should be interested in looking around at its given industry to understand in what way business operations can be improved. So best practices is connected with the idea of improvement, which means, logically, that policies and procedures aren't written once and then kept fixed forever. They must be reviewed from time to time. They should be reviewed because they need to be updated and adapted to circumstances. Okay, that's enough with regard to policies and procedures. Let's move on to effective control over transactions. Okay, let's take a business organization that sort of makes and sells things. In order to do this profitably, clearly the transactions that the company performs have to be properly controlled. In other words, here are the steps. Effective control would mean that the transactions are initiated and that they are executed, that means performed, carried out, and recorded, this is record keeping, according to standard rules which are predefined. The reason being that the company wants to perform these transactions profitably and not to make any losses along the way. Now, this may be a very a common sense idea, but I think the important thing is that effectively in a business organization, which is a controlled environment, nothing should be left to chance. Particularly if one wants to prevent errors. That means somebody making a mistake, which is absolutely human, or events of fraud. Less pleasant, of course, because that means that somebody is motivated to steal something from the company. And of course, management, as one can imagine, has a duty and a responsibility to shareholders. Responsibility to shareholders. Always keep in mind the ultimate reporting or level of accountability that exists here. Okay, now how do we record transactions? Well, we have accounting systems that do this, and we have the famous double entry bookkeeping system, which means that every time a transaction is recorded, it gives rise to two entries that have to be recorded in the books, the accounting books of the company. And the double entry bookkeeping system works on a system of debits and credits, where debits have to equal the credits. This is the way in which a set of financial statements, the balance sheet and so on, will actually reconcile. A balance sheet, as the name suggests, must balance. In other words, the debits and the credits must equal each other. So if we have two entries to record one transaction, one can imagine, therefore, that one of the entries is a debit and the other one is a credit. And since they are equal to each other numerically, it gives a good way to be able to properly record and supervise transactions. Now, here's the rule to keep in mind. What the debit means. It would denote an increase in assets. So if we were to debit assets, let's say the amount that we have in inventory has gone up from $100 to $150. One could see this as being the increase as being a debit to assets, since inventory is a kind of asset, $50. If the corresponding credit, which would be equal to this $50, for example, if you were to look at a balance sheet and you saw that inventory, i.e. assets, had gone up by $50, and you look on the liability side of the balance sheet, we may see there, for example, that payables have also gone up by $50. In other words, we owe somebody $50 as payment for the increase in the inventory. Since the credit to the liabilities records an increase, you can see here credits mean an increase in liabilities, then we would have an increase in assets, $50, that's the inventory going up, and an increase in liabilities, that would be, for example, payable to our supplier, also going up by $50. We can also look at other movements and other transactions which give rise to an increase in assets on the one hand and a decrease with a corresponding credit which indicates a decrease in assets. That would be simply if we were to remove dollars from the cash in our balance sheet, that would be a decrease in assets. Let's say we took out $100 from the assets, $100, that would be a decrease. That would be a credit to our assets, a decrease. And if we were to put that $100 into buying some equipment, let's say a printer or something, which we would then put into our balance sheet among the assets, then we would have a corresponding increase in assets, i.e. a debit to our assets for equipment, which would also be recorded at $100. Again, you can see that there is an offset. Debits must equal credits. These sorts of transactions are described and explained and practiced in other parts of the Foundations in Accountancy course. in much greater detail, of course. This is just a introductory mention to what the idea is about double entry bookkeeping. Okay, the next step is that we should be aware of the fact that all the transactions that we have to record in our books, we call the document that captures these transactions general ledgers. So the input into the general ledger will be the details regarding transactions themselves. So if we use, for example, cash to buy some building materials, we will have a receipt for the building materials. The receipt itself will be a transaction document, which is considered to be raw data. We use the information that's contained in the receipt in order to be able to record the purchase of building materials in our official financial records, which we will call books of prime entry. And the most commonly used books are listed here. Let's just go through them briefly. As you can imagine, cash, there's a cash book which keeps track of the movement of cash that we have in the bank. Okay, so the business normally will have a bank account, and therefore it should be able to track what cash it has available for business purposes. If the business sells things and issues invoices and says, please pay into our bank account so much, then this is such payments are going to be recorded going into the bank account balance. Then there's a cash payments book. That would be for cash going out of the business in payment for things. Then there's petty cash. Now, normally business will keep most of its cash with a bank on deposit. It's safer that way, but it needs to have, for daily incidentals, it needs to have some cash on hand, and this is called the petty cash. Next, we have a book of original entry, which is called a sales day book. It's recording sales which are done on credit. What do we mean by sales on credit? That means that we sell something to a customer. We do not collect cash immediately, but we are paid after a period of time. But of course, the sale is recorded in our books. It generates sales revenue. The purchases day book refers to purchases that we make to buy things that we're going to resell. So purchases concerns the buying of merchandise into a business and the payments that connected to those purchases. If the purchases are settled with cash immediately, then of course the cash payments book is going to be affected, or the petty cash book if the amount is a smaller, sort of more incidental amount. If that's not the case and the purchase is made from a supplier with, say, 30 days payment terms, then the transaction is recorded in the purchases day book. But of course, we have to make sure that the cash payment will effectively be made on time after the 30 days. And then, as one can imagine, for other sorts of transactions that are not covered anywhere here, they should be recorded in something called a journal book. Okay, one wants to keep in mind some distinctions here between integrated systems. That's where the cost and financial accounts are kept inside the same set of books, and interlocking systems, which would mean that we would have separate systems that are tracking both costs on one side and the resulting financial accounts on the other, but they have to somehow speak to each other or be reconciled with each other. Of course, this sort of thing is made much easier by using computerized accounting systems This means that one can work more efficiently and hopefully in a more cost-effective way. Fewer errors. Usually the software should be designed in such a way that if an input error were made, for example, somebody were to record debit $50 and credit $52, the system would notice that, debits do not equal credits, and therefore clearly some sort of discrepancy has occurred. So hopefully the system will speak up, will alert the operator to the fact that there is an error that's being made in the input. Okay. Of course, in order to put a computerized system into place, it can be a costly investment, but hopefully the benefits will be experienced over time.